In order to, and let's begin first with a balance sheet. We'll always head up the financial statement with the name of the business, in this particular case, XYZ Corporation, and then the name of the financial statement, in this case, the balance sheet, or sometimes referred to as a statement of financial position, plus finally the dates associated with the financial statement. In this particular case, this is a balance sheet as of December 31st in the year 20X1 and December 31st in the year of 20X2. It's important to properly designate the dates. In this particular case, this is a listing of the assets, liabilities, and owner's equity of a business, the financial position of the business, as of the close of business on December 31st, 20X1, and the close of business on December 31st, 20X2. In other words, under the assets section of the balance sheet for 12/31X1, at the close of business, 12/31X1, the amount of cash was $14,000. And a year later, the balance of cash as of the close of business on 12/31X2 amounted to $21,000. This financial statement does not describe what happened between 12/31X1 and 12/31X2. It is simply stating the amount of our assets as of one point in time, the close of business on 12/31, December 31st, X1, and as of the close of business on December 31st, X2. It is not a description of what happened in between. Now let's look and notice here that we're going to identify first on this balance sheet all of our assets. But we're going to classify those assets as either current or long-term assets. These are really subcategories within the section of assets. This is an important characterization, which I'll discuss in a few moments. But first, I'd like to distinguish what is the difference between a current versus long-term asset. A current asset is cash or any asset that can and will be converted to cash within 1 year, or also any asset that will actually be used up within 1 year. For example, cash is cash or converted to cash within 1 year. Clearly, cash would be a current asset given this definition that we provided. Accounts receivable. In this case, at 12/31X1, a balance of $28,000 represents receivables from customers as a result of sales of goods or services to customers on account. Usually when we make sales on account, we expect to collect an account receivable, usually within 30 days. So this balance of $28,000 of accounts receivable at the end of 12/31X1 are receivables that we expect to collect in the form of cash within the next 30 days or so, certainly within the next year. So accounts receivable would qualify under this definition of current versus long-term assets. Again, current assets being any asset that is either cash or will be converted to cash within 1 year or will be used up within a 1-year period. Let's look at inventory. It's currently classified here under current assets. Is that appropriate and proper? Well, inventory, 12/31X1, the balance is $32,000 of inventory. This inventory we expect to sell. And we expect to sell it hopefully in the near term here, hopefully within the next month or 2 or 3. We hope to sell that inventory to customers, and as a result, convert the inventory to either cash as customers pay us, hopefully a higher price for the inventory because they're going to pay us more than what that inventory costs, or they're going to purchase it on account, in which case we would receive an account receivable in exchange for the inventory, but ultimately, hopefully, collect that accounts receivable within 30 days. So theoretically, we ought to, within the next year, sell this inventory to customers and either receive cash at the point of sale or upon collection of an account receivable arising from that sale. So cash, accounts receivable, inventory are common current assets because they're likely to be either cash or converted to cash within the next year. Now let's look at some of the long-term assets, and some of the more common ones are, as noted here, land and buildings or equipment. Certainly land and buildings, if we're not in the real estate business where we're buying and selling land or building, we'll buy some land, buildings for our manufacturing facility or for our retailing store or whatever, and plan to operate out of that building for more than 1 year. We're buying land, building equipment, usually to utilize those resources to assist our business in its operations for more than a 1-year term. But the fact of the matter is that land and buildings can be sold and converted to cash virtually whenever we want to, as long as we sell it for a reasonable price. I mean, building companies that aren't in the real estate business sometimes periodically will sell land, buildings, or equipment because they're improving or upgrading or these kinds of things. So it is actually possible that land, buildings, equipment, which typically are long-term assets, might actually be classified as a current asset. But under what scenario would that be appropriate? Well, if management is actually planning to sell land, building, or equipment within the next year, planning to convert it to cash, then it would be appropriate to show that particular asset, normally classified as a long-term asset, as a current asset. But it must be an asset which can be sold, and it's expected to be sold. It's the intention of management that it be sold, and therefore converted to cash within 1 year. If we take all of our assets and classify them as either current assets or assets that aren't expected to be converted to cash within 1 year, long-term assets, in this case land and buildings and equipment, and add them all together, we then get our total of total assets. The bottom part of this balance sheet, and sometimes it's shown vertically or sometimes side by side, where we might show the liabilities and owner's equity on the right-hand side or horizontal from the assets, but in this case, just building them from top to bottom, either way is okay. We're going to list all of our liabilities and then our owner's equity. But likewise, as we have classified assets as either current or long-term assets, we're also going to classify our liabilities as either current or long-term liabilities. Current liabilities are obligations, as all liabilities are, but obligations that we must pay within 1 year. Well, let's look at these particular obligations identified here in this balance sheet. Accounts payable, and at 12/31/X1, that balance amounts to $25,000. This balance of accounts payable arose as a result of purchases of inventory. That's the definition of what accounts payable is. Obligations arising from the purchase of inventory. Typically, when we buy inventory on account and enter into an account payable, this obligation, usually our suppliers or vendors will give us about 30 days to pay this obligation. So generally speaking, most accounts payable will in fact be current liabilities for which we have an obligation to make payment within 1 year. Other payables, which might include salaries payable or income taxes payable or utilities payable or any kind of other obligation that is required to be paid within the next upcoming year, would also be included in this amount or classification of current liabilities. As a result, any obligations that are to be paid in a term that extends beyond the next year would be referred to as long-term liabilities. Now, the reason why this classification of current assets from long-term assets and current liabilities from long-term liabilities is that it allows us a way to try and measure the liquidity of a business. Well, what is liquidity? Liquidity refers to a business's ability to meet its obligations in the short term. What it really means is can we pay our debts here over the next month or 2 months or even over the next year? Since we're going to pay our obligations that are here in the near term that we have at this point in time and have to be paid in the next year with either cash, or we're going to be converting some assets that aren't currently cash to cash in the very short term, such that then that cash can be used to pay obligations here in the short term. It will take all of our current assets. And now let's look at 1231X2 and look at all of the current assets. Cash, $21,000, accounts receivable of $30,000, and finally inventory of $36,000. This is our cash or assets going to be converted to cash within a short period of time, and it totals $87,000. If we'll then take that $87,000 of total current assets and compare it to our total current liabilities, and again at 1231X2, the current liabilities are accounts payable of $27,000 and other payables of $16,000 for total current liabilities of $43,000, we can see that it looks like we have ample current assets sufficient to cover our obligations, current liabilities that are due within 1 year. See, this gives us a measure or sense for whether or not the company is liquid or in a position to meet their obligations in the short term. That is why we'll make this distinction between current versus long-term assets and liabilities. The last section of the balance sheet is owner's equity, and there are 2 subcategories always below owner's equity, because there are only 2 ways that owners provide resources to a business that's reflected in this amount of owner's equity. Owners either provide resources to the business by making capital contributions in exchange for ownership interests, typically referred to as capital stock, or they provide resources to the business by allowing the earnings of the business, or resources created through profitable operations, to be retained in the business. So under owner's equity, we will always see the caption of contributed capital, or referred to as capital stock, plus retained earnings, giving us a total owner's equity. And if we combined all of our liabilities, current and long-term liabilities, total liabilities, in this particular case, total liabilities amounted to $498,000, and the total owner's equity amounted to $390,000, our total liabilities, current and long-term, and owner's equity, amounts to $888,000. That total should balance with the amount of our total assets. One of the things that I do want to point out is that, again, investors and creditors are going to be looking at this balance sheet and trying to make investment decisions about whether they'd be willing to make loans to this business, XYZ Corporation, or even invest in the business's stock. One of the things that we do notice here is that under owner's equity and next to the caption of capital stock, we see that this company has 10,000 shares outstanding. Since there's $100,000 of contributed capital, both at the beginning of the year, 20X2, or at the end of 1231X1, and at the end of 1231X2, we can see that apparently the owners to this business have contributed about $10 per share on average for each share of stock. You have 10,000 shares outstanding and $100,000 of contributed capital. Apparently, on average, the owners have contributed $10 per share of stock. And we can see that they have made no contributions during the last year. In fact, one of the things that an investor and creditor will want to do will be to make a comparison of the balance sheet as of the end of last year and as of the end of this year, so that they can make some evaluation of what caused a change, or in this particular case, an increase in the total assets from 1 year to the next. This is what we've been talking about. We want to provide comparative balance sheets and financial statements that provide at least amounts for more than 1 year so that we can make comparisons from 1 year to the next. In this particular case, simple analysis shows us that the total assets of the company have increased from last year to this year by $226,000. It's increased from $662,000 of total assets to $888,000 of total assets. This company is growing. It's increased by $226,000 of assets. The bottom part of this balance sheet, the section for liabilities and owner's equity, explains to us how this growth in assets was financed. If we'll look at total liabilities, which amounted to $382,000 at the end of the prior year, and is now $498,000 at the end of this current year, we can come to the conclusion that of the growth in assets, $116,000 worth of it has been financed by increased liabilities, or they're financing a good portion of the growth in assets by incurring additional debts. The remaining explanation of the financing for this particular company comes by comparing the balances under the owner's equity section of the balance sheet. Again, we see that contributed capital or capital stock has not increased, but we do see that retained earnings has increased from a balance of $180,000 at the end of X1 to $290,000 at the end of the current year, 20X2. That's a $110,000 increase in retained earnings. Clearly, this has been a profitable business. They have earnings during the year, have had earnings during the year that were at least $110,000 that they have retained in the business, and as a result, they have created additional assets of the business by allowing those earnings, the assets created through earnings, to be retained in the business. Okay, that's enough with this basic format of the balance sheet. Now let's look at the format for a statement of retained earnings, which is not really a required general purpose financial statement under generally accepted accounting principles, but again is commonly provided. Again, we'll start with the name of the corporation, XYZ Corporation, and then the title of this particular statement is the Statement of Retained Earnings, or sometimes referred to as a statement of changes in retained earnings. Either way is okay. Notice that the dating for this statement is a little bit different than we saw for the balance sheet. This is for the years ended December 31st, 20X1 and 20X2. It is not reflective of balances as of the end of the year, but this is an expression of what happened during the year. This is a statement of retained earnings for the years. What happened during the year December 31st, 20X1, and what happened during the year December that ended at December 31st, 20X2. Now, what I'd like you to do here is look at the far right column. Let's look for just a moment just at the year 20X2. At the end of the year, for 20X2, we begin this financial statement by stating first the beginning balance of retained earnings for that year. Retained earnings at the beginning of the year amounts, for the year 20X2, amounts to $180,000. Now, the balance of retained earnings at the beginning of this year, 20X2, which is January 1st, the start of business January 1st, 20X2, well, that balance is exactly the same balance as of the end of the year 12/31X1. I mean, if we're at the close of business on December 31st, the balance of retained earnings is $180,000, which I can find on my balance sheet. The ending balance in retained earnings at December 31st, X1, is $180,000 on the balance sheet. But that balance at the end or close of business on December 31st, 20X1, is the balance that we have then as we start the very next day, January 1st, 20X2. So it really is the ending balance of X1, but then the beginning balance for X2. So that is where this balance of $180,000 comes from. It comes from the ending balance, given the balance sheet, at 12/31/X1. There are only two things that affect retained earnings. Retained earnings are increased for any earnings during the year. Earnings are net income. So we're going to add net income for the year. In this particular case, apparently the net income amounted to $150,000. And will reflect as a reduction of the earnings retained in the business any of these earnings that have been distributed to owners that aren't being retained, that are being distributed to owners in the form of a dividend. And that is what a dividend is. It's simply assets that have been created through the profitable operations or earnings of the business that are then distributed to the owners for their own personal use. And so dividends represent a reduction of the earnings retained in the business because it says that we're really taking some of the earnings and distributing them to owners. And so any dividends paid out during the year would be a reduction in the balance of retained earnings, therefore yielding to us the ending balance of retained earnings at the end of this year, 20X2, which amounts to $290,000. And if we'll go back now and look at the balance sheet that we had previously looked at, we'll see that the ending balance of retained earnings for 12/31/X2 is $290,000. And really what we've done here is simply explain what happened that would cause the change in retained earnings from the balance at the end of X1 to the balance at the end of X2, going from $180,000 to $290,000 during that year. The explanation is that we were profitable to the tune of $150,000 less $40,000 of dividends distributed out of those earnings to the owners. And again, we could have looked at the year 20X1 and looked at what happened during the year 20X1 relative to a beginning balance and then the ending balance of $180,000 at the end of that year. And we see that in the prior year, they were also profitable to the tune of $75,000, of which $25,000 worth of those earnings were paid out in a dividend to the owners. So we can see by looking at this statement of retained earnings that this is a company with increasing retained earnings because the company has been profitable. And in fact, the profits have more than doubled from the year 20X1 to 20X2, and they have paid out a portion of those profits, not all of them, but a portion of those profits to the owners of the business in the amounts reflected. The next formatted financial statement that we'll look at is the required income statement, or sometimes referred to as statement of operations or statement of earnings. So we'll put the title in there, whichever one of those particular names we like. And then we'll put the date. And again, look at the date here carefully, because this income statement reflects information for the years ended December 31st, 20X1 and 20X2. Again, just as the statement of retained earnings is a statement that reflects activity during a period of time, not simply an ending balance as of a point in time, as the balance sheet did, this income statement reflects the amount of revenues for an entire year. It represents the total amount of activity for a 12-month period of time. And so that is reflected here. This is very important because sometimes companies will provide financial statements that are monthly financial statements. And so you might see an income statement that has and expenses for the last month or the last quarter. So distinguishing for what period this reflects the revenues and expenses of a business is very, very important. And then you'll see here that again we have the 2 years of performance, 20X1 and 20X2, and then we'll simply list all the revenues, add them up for total revenues, and then deduct all of the expenses to create for us net income. Now, the net income amounts to $75,000 at the end of, for the year 20X1, and $150,000 for the year 20x2. We kind of already knew by looking at this statement of retained earnings that this is a company with increasing retained earnings because the company has been profitable. The reason why this income statement is so valuable or beneficial is because it explains to us how we generated that income. What was the amount of our revenues and what were our expenses that give rise to net income? And again, this is important, more detailed information to us. In this particular case, we can see that the company's sales revenues actually increased by over 20%, by increasing from $2,540,000 in the year ended 20x1 to over $3,175,000 here in 20x2. So this is a company who is increasing their net income. Yes, they were more profitable by $75,000, increasing net income from $75,000 to $150,000. And part of the reason for that is they've increased their sales revenues or in terms of providing goods and services to customers. And yes, they did have increased expenses, as we see that expenses increased, but not nearly as much as the increase in their revenues, generating for them a higher net income. It is required under generally accepted accounting principles that immediately following net income, we also make a calculation that determines our earnings per share. Sometimes this is abbreviated as EPS. Earnings per share, in its simplest calculation, which we'll do at this point in time because we're really just introducing you to this new language and to these financial statements, we'll simply suggest that earnings per share is calculated by taking the net income. At the end of X2, the income for that full year amounted to $150,000. So we'll take $150,000 and divide it by the number of shares of stock that are outstanding or held by shareholders. The total number of shares of stock were 10,000 shares. That means the net income per share is $150,000 divided by 10,000 shares, or $15 per share. This is a very important calculation that we'll see in later chapters as we begin to do some financial statement analysis. Finally, the last required financial statement is the statement of cash flows. And again, we'll head this up by calling it XYZ Corporation, designating it as a statement of cash flows. And again, this is a statement that reflects activity over a period of time. In this case, for the years ended December 31st, 20x1 and 20x2. And again, because it's a statement of activity over a period of time, and the purpose of the statement of cash flows is to simply identify for us what happened or caused an increase or decrease in cash from the beginning of the year to the end of the year. Let's look at column 20x2 to show the activity during 20x2. And in this particular case, we're going to show the cash at the beginning of the year, which amounts to $14,000. Now again, I actually find that number, $14,000 cash at the beginning of the year, by looking at the balance sheet and looking at the ending balance at the close of business 12/31/20x1, because the ending balance on December 31st, 20x1 is the beginning balance on the next day, January 1st, at the start of business for the next year. So the beginning cash balance for 20x1 is really the ending cash balance for 20x2 is actually the ending balance for the previous year, 20x1. So the cash balance is $14,000, and as we noted previously, we will distinguish the cash inflows and outflows into three distinctive categories: net cash flows from operations, the sale of goods or services for cash to customers or collections on accounts receivable from customers, less cash outflows to pay the costs of providing those goods or services. That's the net cash flow from operations. And apparently in this particular case, we had $179,000 cash inflow to the business as a result of our operations and transactions with customers and our various costs of providing goods or services. We also took some of that cash and invested in additional buildings and land and equipment that provide for longer-term services or operations of our business. And so this investing in longer-term assets apparently amounted to, in the year 20X2, about $377,000, for which we used cash to buy some of these resources. Apparently, we provided additional financing or sources of cash from financing of our business. This is $135,000, most likely the majority of it coming from additional borrowings, because we know we financed the growth of the business by borrowing many of the resources, increasing our current and long-term liabilities. The net result of all of these cash inflows and outflows is that our net cash balance, or our cash balance at the end of the year 20X2, is $21,000. In other words, after all of our transactions involving cash, we started the year with $14,000 and end the year with $21,000. This is good to know because cash is extremely critical, and we need to make sure that we're going to have sufficient cash to continue to operate and pay our obligations in the future. It's very good to know that we had $179,000 of cash inflows to the business from the operations of the business. In fact, if we are discovering that we may have cash shortages, it looks like we're generating a lot of cash from operations, and we simply won't purchase as much land or building or invest in effectively longer-term resources if, in fact, we needed to generate more cash in the future, higher cash balances. But at this point in time, it appears that we have sufficient cash for our operations, and in fact, the balance has increased during the year by about $7,000.